Day 20. What is the best mortgage structure? Now, this is a trick question because there is no best mortgage structure, and especially not in a generic sense like this. But everybody has a strong opinion when you ask them about mortgages, and especially about how long to refix for. They've got opinions on whether interest rates are going up or down. It can be really confusing because there are a lot of strong opinions out there. You ask uncles, friends, neighbors, taxi drivers, hairdressers, people are going to have something to say, and every day there's something in the Herald or on stuff or online about interest rates, about the economy, whether it's doom and gloom or excitement. There's a lot of information to take in. Some people are going to say fix for 5 years, some are going to say 1 and 3, some are going to say stay floating. Some people are going to say max out your repayments. There's going to be all sorts of conflicting advice, and it's going to be from people that are quite far ahead of you, or people that are nowhere near as far along as you. So the thing that you've got to get comfortable with is there's always going to be uncertainty. And if you go to the economists as a good baseline, if you see that all of the bank economists and independent economists, they're frequently quoted online, they've all got their own newsletters, and you've got to remember that their job is to stay relevant, and that boring announcements don't get much press or much readership. So it's actually, you've got to understand what their goals are, is to stay in the limelight, and sometimes that means publishing things about doom and gloom, or they end up actually being quite far wrong, and then they go and apologize. Now you can go and read, go back 6, 12 months, even 24 months, go back and read the predictions from economists, and you will just laugh and laugh and laugh, because you will see what actually happened versus what they were saying was going to happen. And even in Australia, they do a report from bank economists where they track the predictions and then what actually happened and how far away they were from their predictions. And it's massive errors across the board. And trying to pick which economist is going to be right, if any of them, is like going to the horse races. So you've just got to be careful about anyone, including economists, that have delusional confidence about where interest rates are going and how long you should fix for, because everybody is guessing. People can't predict things like wars or about shortages or about market crashes with exact relevance of the time. So if people are right, it's because they were right on that day. Even though they've been predicting a market crash for a year or two, they'll say, see, I was right. And you can go back and say, well, you've been predicting this for a very long time. So interest rate averaging is going to be the thing that saves most people from, one, the decision, having to make a decision, and two, from being right or wrong, and being too far away from being right or wrong. So interest rate averaging is, let's say you got a $500,000 mortgage, you might fix $150,000 on 1 year, $150,000 on 2 year, and put $150,000 on 3 year, and leave $50K floating in your, and that gives you the ability to assess the market every year, to flatten the curve on interest rate fluctuations, and to make lump sums or make changes each year without big break fee penalties. So you really want to understand interest rate averaging and accept that timing the market, even if you're right sometimes, is a bit of a fool's game, because sometimes you're going to be wrong. So you might win in a big way by getting lower rates than you would have. But on the other flip side, if you fixed everything for 12 months 1 year, and then you came later on, and then you've got full exposure to the massive increases that have happened in that time, what is a safer thing to do is just to have a stepped approach, so that you're not exposed each year or every 2 or 3 years to your whole mortgage repayment changing. And this is a very basic concept that a lot of advisors even don't follow, and they forget sometimes, is if you're worried about the shock of your repayments changing, this is the safest thing to do, interest rate averaging. The perfect structure is always going to depend on things like age, kids, what your plans for the future are. So interest rate averaging, a third, or half, or 25%, just breaking it down into certain sections, that's going to help reduce your impact to major changes. And it should make things like equity release a bit easier. It's going to minimize your exposure to break fees if you sell your property unexpectedly or midterm. And like the only real caveat I have for fixing short term, like in a standardized approach like this, is if you're on a low equity margin or low equity fee, then you've probably got less than 20% equity. It means you would have bought your house recently, probably on a 10 to 20% deposit. What you're waiting for is for that equity to trigger over to 20%, and then your interest rates will be able to go down and you either restructure or refinance. So if you're on a low equity margin or anything low equity based, you don't want to be fixing for too long, because then by the time you've got your equity build up, you won't be able to take advantage of those rates without break fees, the lower rates, because usually there's higher rates for people on those terms. So if you've got any questions about interest rate averaging or trying to figure out how long you should refix for, let us know below. But generally speaking, we try not to be speculators here. We're trying to be safer investors, which means we're happy to leave a little bit on the table sometimes, but also to make sure that we don't lose big. So interest rate averaging is the pragmatic approach instead of trying to time the market, which we know some people won't get right.